Have you ever felt like the Trump administration is playing with fire in a world that could go up in flames at any moment? This will impact you, no matter if you are an American citizen or not, whether you live in New York, London, Bucharest, or anywhere else around the globe. By the time this episode is over, you will understand how this is happening and why your money is paying the price. So make sure you watch until the end. When power shifts hands, money shifts form. Right now, the world's oldest power currency is under attack from the inside. If your haircut costs more than last year, if filling up your car suddenly hurts, if eating out feels like a luxury again, this episode's for you. If you've noticed the dollar weakening, while certain cryptocurrencies get political support, this episode's for you. Let's follow the thread. Who moves your money? Before a currency rises, before it collapses, before your savings gain or lose power, there is always a decision behind the curtain. Not mystical, not hidden in shadows, just choices made by institutions, central banks, and governments, trying to steer a system far more complex than the humans running it. Interest rates don't jump on their own. Inflation doesn't appear out of nowhere. Currencies don't strengthen or weaken by magic. Everything is a reaction to pressure, data, politics, and the constant attempt to balance a machine that never rests. And when these decisions shift, your reality shifts with them, often before you even notice. A small rate change, a new policy, a liquidity injection, a sudden restriction. These don't just affect markets. They affect your daily life in ways so quiet you only feel them when the numbers stop adding up. And that brings us to the first truth. You don't experience monetary policy through charts or economic papers. You experience it at the supermarket, in your bills, in your savings, in your ability to breathe between paychecks. When value moves, you move with it, whether you want to or not. And that's why the architects matter. Not because they are villains, not because they control everything, but because their decisions become your environment before you get a chance to understand them. So here's a parable. You drink the same coffee every morning. Same drink, same place, same ritual. Yesterday it cost 10 coins. Today it costs 12. Nothing has changed. Only your currency became weaker. The quality is the same. The barista is the same. You are the same. Only the value of your money has shrunk. And you didn't find out from the news. You found out at the counter. That's how monetary decisions touch your life. Quietly, invisibly, without permission. You don't see them forming. You only see the ripple. A currency doesn't weaken when the price changes. It weakens long before, in boardrooms, in policy meetings, in spreadsheets full of assumptions that later become your reality. And the strangest part? You don't vote for these changes. You only pay for them. When a central bank adjusts a rate, your mortgage shifts, your rent shifts, your savings shift, your future shifts. Not because you were reckless, but because someone, somewhere, turned a dial by 0.25%. This is the hidden weight of money. Its value is not in your hands, but in the hands of those who manage it. You can work harder, save more, plan better, and still lose ground because a curve on an economist's screen tilted the wrong way. So the real question isn't, why did my coffee get more expensive? The real question is, who weakened my money before I reached the counter? The hands that move a currency. A currency never moves alone. Behind every rise, every drop, every sudden shift, there is a hand on the wheel. Not one hand, not one mastermind. Five forces that shape the value of your money long before you touch it. The central bank, the pulse setter. The first hand on your currency is the central bank. It controls the interest rate, the price of time. Raise it and the currency strengthens. Lower it and the currency weakens. But that's only half the story. A central bank also controls how many units of money exist. More money in the system weakens the currency. Less money, strengthening it. You don't hear these decisions in words. You feel them in the cost of your loans, in the rhythm of your savings, in the quiet expansion or shrinking of your purchasing power. Here's a parable about your money and how a central bank can reshape its value without ever touching your wallet. Imagine a classroom. Every Monday morning, the teacher gives each student 10 class coins to last the whole week. These class coins buy pencils, snacks, extra break time, small things everyone values. At the beginning, it all works. A pencil costs 1 class coin. A snack costs 2 class coins. Extra break time costs 4 class coins. Students learn to choose 2 pencils or 1 snack, a snack or half a break, a full break or 2 whole snacks. The class coins are limited, so every decision matters. One Monday, the teacher decides everyone deserves more freedom and gives each student 20 class coins instead of 10. This is what monetary expansion looks like in an economy. At first, it feels amazing. Everyone can afford more of everything. More pencils, more snacks, more break time. But the pencils are limited. The snacks are limited. The break schedule is limited. So by midweek, there aren't enough to go around. The students who sell snacks and pencils start raising prices. Pencils go from 1 to 2 class coins, snacks from 2 to 4, break time from 4 to 8. Nothing about the pencils changed. Nothing about the snacks changed. Nothing about the classroom changed. Only the number of class coins did. So each class coin now buys less. The next Monday, the teacher realizes things are overheating and goes back to 10 class coins per week. But the prices don't magically return. Pencils stay expensive. Snacks stay high. Break time doesn't get cheaper. The rules can change overnight, but behavior takes longer to adjust. That's what happens when a central bank expands and then tightens money. You don't feel it in the policy meeting. You feel it when your class coins don't stretch as far as they used to. The administration, government, the storyteller. The second hand on your currency is the administration, the storyteller. Budgets, taxes, spending plans, public debt. These don't just shape policy. They shape belief, and belief shapes the value of a currency. A disciplined government strengthens confidence. A reckless one weakens it. And markets react to these decisions long before voters do. Governments don't print money with machines. They print belief with decisions. A promise to spend more. A promise to cut taxes. A promise to borrow heavily. Each one reshapes expectations and moves the currency before a single dollar is actually spent. Here's how the government impacts your wealth. Same school, same class coins, but above the teacher sits the principal. The teacher controls how many class coins students get, but the principal controls what those coins are supposed to buy and how valuable they feel. One day, the principal makes a big announcement. Great news! Starting next month, class coins will get you new clubs, better supplies, special activities, and extra privileges. Students get excited. Teachers relax. Everyone believes the school is about to upgrade. But there's a detail nobody checks. The school doesn't actually have the resources to offer all those upgrades. Still, the story spreads. Students start saving more class coins, expecting they'll soon be able to buy better things with the same money. Class coins feel stronger because everyone trusts the principal's plan. But weeks pass. No new clubs, no new supplies, no special activities. The extra privileges never appear. At first, students are confused, then frustrated, and slowly, trust weakens. If the principal's promises don't mean much, maybe the value of class coins doesn't either. Students stop saving them. Prices drift upward. A snack that used to cost 2 coins now costs 3. Break time rises from 4 coins to 5, not because the teacher printed more money, but because confidence collapsed. A currency doesn't weaken only when more of it is created. It weakens when the story behind it breaks. And in every economy, the government is the storyteller. When the story is solid, the currency stands tall. When the story cracks, the currency follows. That's how a government moves your money, not with printing machines, but with credibility, or the lack of it. Markets plus the real economy, the mirror and the muscle. The third hand that moves a currency is the hand made of millions of smaller hands. Workers, investors, businesses, exporters, consumers, all acting, reacting, adjusting to whatever reality they wake up in. This hand does 2 things at once. The real economy creates value, actual goods, actual services, actual productivity, factories, logistics, innovation, labor, output. That's the muscle. The financial markets don't create products. They redistribute capital toward whatever looks safer, faster, or more profitable. That's the mirror. And your currency reacts to both. It strengthens when production grows, and it weakens when fear redirects capital elsewhere. People say markets are emotional, but that's not really true. Markets simply amplify the emotions people bring into them: confidence, fear, greed, caution. When factories hum, when companies hire, when people buy, sell, invest, expand, the currency breathes easier. But when confidence cracks, even slightly, capital starts moving like water, finding a safer slope. And a currency can lose value not because anything broke, but because belief shifted. International forces, the gravity of global capital. A currency is never valued only by the people who use it. It's valued by the world that trades with it. Global investors, funds, corporations, exporters, commodity buyers, they all move capital across borders in search of one thing: the best mix of return and safety. If your country becomes more attractive, stable politics, rising productivity, higher interest rates, capital flows in. Foreign money arrives to invest, to build, to buy. But to invest, they need your currency. So demand rises, and your currency strengthens. But if another country becomes more attractive, with safer bonds, higher yields, stronger growth, capital flows out. Not because investors dislike your country, not because they want to punish it, but because capital has no loyalty, only calculation. When capital leaves, your currency weakens. Imports become more expensive. Debt becomes heavier. Living costs rise. Confidence fades. All because investors, somewhere far away, decided another currency offered better conditions. Your currency could be perfectly fine, but if someone else offers a slightly better deal, global capital doesn't hesitate. It moves like water, downhill, toward yield. This is the fourth hand. The invisible gravity of global money. It doesn't ask your permission. It doesn't need your approval. It simply moves where the reward is highest and the risk is lowest. And when it moves, your currency moves with it, whether you agree with the decision or not. The unexpected, chaos, crisis, and the unforgiving world. The fifth hand is the one that rewrites everything in an afternoon. Crises, pandemics, wars, shocks that arrive uninvited and redraw the map faster than any policy ever could. These forces don't wait for committees. They don't respect forecasts. They don't care what the charts predicted yesterday. A conflict erupts. Capital flees to safer currencies. A supply chain snaps. Prices jump overnight. A disaster hits. Economies freeze. Every currency looks strong until the world decides to test it. Some bend, some break, some vanish in a single news cycle. The consequences you feel before you understand. You don't wake up thinking about interest rates, capital flows, or global liquidity. You wake up thinking, can I still afford my life? Currencies move in headlines, but you don't live in headlines. You live in prices. How currency moves hit you first. When a currency weakens, it doesn't send you a letter, it sends you a bill. Fuel goes up, food goes up, rent negotiations feel tighter. Your salary looks the same on paper, but it shrinks in the supermarket. A weaker currency makes imports more expensive. Energy, electronics, medicine, anything that crosses a border crosses it with a premium. If your income doesn't grow with it, you pay the difference with your quality of life. When a currency strengthens, the story flips. Imported goods get cheaper. Vacations cost less. Online orders feel lighter. But exporters suffer. Their goods become more expensive for everyone else. There is no good or bad move. There are winners and losers every time the needle shifts. The illusion you're trained to blame. Most humans don't say, "My currency weakened." They say, "Everything got more expensive." You blame the shop. You blame the landlord. You blame the brand. But the truth often sits one level deeper. If the money you earn buys less fuel, less food, less future than it did a year ago, you are not just facing greedy companies, you are facing a weaker measuring stick. A loaf of bread at 5 becomes 7. You feel attacked. But behind that change are interest rate decisions, capital flows, fiscal deficits, global tensions. You never voted on them. You just pay their price. You're told to work harder, learn new skills, be more productive. But if the currency underneath you slides faster than your effort rises, you can run all you want. The treadmill owns the distance. Parable. Same effort, different reality. Picture 2 years of your life. Same job, same effort, same hours, same 10 on your payslip. In year 1, those 10 units of salary cover rent, food, transport, a small safety cushion, maybe even a little joy. In year 2, you earn the same 10, but rent climbed, food climbed, fuel climbed. You worked just as hard. The number didn't change, but the value did. Your real income dropped without ever being lowered on paper. That's what currency weakness feels like from the inside, not as charts, but as tension. And if you don't understand what's happening underneath, you'll spend your life blaming prices instead of understanding the floor. The thread of escape, moving with the maze, not against it. If 5 hands can move your money without asking you, you need a 6th hand, your own. You can't stop currencies from moving. You can't control central banks, governments, markets, crises, but you can decide where your value lives while they move. Protecting yourself, hedge your reality. If all your wealth lives inside a single currency, your future depends entirely on the choices of the people who manage that currency. So you protect yourself the way every stable system does, by spreading your foundation. Part in your local currency, to live. Part in more stable currencies, to breathe. Part in productive assets, to grow. Part in globally recognized stores of value, to resist. What counts as global value? Equities in companies that earn across borders, index funds tied to global markets, real estate that generates income, not just pride, and commodities that outlive inflation. Gold, the old firewall. Silver, its volatile sibling. A touch of platinum, if you understand the cycle. These are anchors. They don't make you rich, they keep you from becoming poor when the currency under you shifts. Why this matters? Hedging is not optimism, it's symmetry. Instead of betting your entire life on the stability of one monetary system, you spread the risk so no single decision, from a bank, the government, or a crisis, can erase your future. You don't know which wall of the maze will move next, but you can choose not to stand against only one. The realization, currency moves are not for experts only. You live inside their consequences. Every time your money buys less, you are paying for decisions you didn't make. You can't grab the hands that move the maze, but you can stop standing still while they do it. You can choose to hold value in places that don't collapse with every policy meeting. You can't control what a central bank does next, but you can control whether your entire life depends on that decision. And if that's true for your local currency, what happens when the world's dominant currency starts being weakened on purpose? In the next act, we follow that thread, the dollar, the decisions around it, and what happens when the maze's main pillar starts to move. The hidden truth, what the Trump administration is doing to the dollar right now. Years ago, while working on my doctoral thesis, I proposed a simple but dangerous idea. Any country with a dominant global currency can reduce its real public debt by printing money and allowing its currency to weaken. Today, the Trump administration is doing exactly that, not by accident, by design. And the impact won't hit only Americans. It will hit anyone living in a world priced in dollars. If you don't subscribe now, you'll miss the full deep dive in the next episode. But here's the foundation you need to understand the maze. U.S. public debt. Record highs, record interest. U.S. public debt has crossed $35 trillion, the highest level in history. But the number itself is not the danger. The real danger is the interest cost. In 2024, the U.S. paid over $1.1 trillion in interest alone, now the largest single federal expense, bigger than defense, bigger than healthcare programs. And every time interest rates rise, the cost of this debt rises with them. So what happens when you can't raise taxes and you don't want to cut spending? You weaken the dollar, and the real weight of the debt shrinks. Great for the government, terrible for your purchasing power. And in the next episode, we'll break down exactly how this debt strategy quietly drains your wealth, even if you've never touched a treasury bond. The government shutdown, frozen institutions, real damage. The federal shutdown began on October 1st. It sent roughly 1,400,000 federal employees into two groups, approximately 730,000 working without pay, approximately 670,000 furloughed entirely. Every shutdown bleeds money. Estimates for the current one reach billions in losses, depending on duration. A government that stops functioning signals a currency that can't count on stability. Confidence drops. Investors hesitate. Capital shifts to safer places. And whether you live in New York or Nairobi, you will feel that in prices, in loans, in global markets tied to dollar liquidity. Next episode, we'll quantify how every week of shutdown accelerates the dollar's slide. Monetary easing through bonds. Quiet, but powerful. The administration has leaned on a softer, less publicized form of monetary stimulus, slowing the pace of Treasury issuance, nudging the Fed toward more accommodative positioning, and signaling tolerance for a weaker dollar. Why does this matter? When investors expect easier policy, they demand fewer dollars. Bond yields shift, capital flows adjust, and the dollar loses altitude. This is how you devalue a currency without ever saying the word devaluation. In the next episode, we'll show exactly which bond operations and signals created the turn. The national shift toward Bitcoin and select cryptos. Under Trump, federal posture toward crypto shifted dramatically. Friendlier regulation, political support for Bitcoin as strategic, institutional encouragement, and expectations of lighter oversight. When a government pushes wealth toward an asset outside its own currency, that currency weakens because confidence leaves with the capital. And yes, the recent Bitcoin drop has been larger than the US dollar drop, but they don't move together. Dollars weaken because of policy. Bitcoin moves on liquidity, speculation, macro fear, or confidence. But when national wealth migrates out of US dollar and into Bitcoin, the message is simple. The dollar is no longer the only pillar. Next episode, we break down whether crypto becomes a hedge, a trap, or a political weapon. Geopolitical actions. The dollar lives on trust. A strong currency isn't just strong today, it must look strong tomorrow. Trade wars, troop withdrawals, aggressive tariffs, sharp shifts in alliances. All of these shake the belief that the US will remain the world's stabilizer. When global players reduce their dollar exposure, you will feel the ripple, whether you're American or not. Imports get pricier, global borrowing costs rise, investment slows. Emerging markets get squeezed. Commodities react instantly because the world is built on US dollar, and when the pillar shakes, every floor shakes with it. Next episode, we break down how each geopolitical decision translates directly into currency pressure. So what we're seeing isn't chaos, it's a deliberate play. Soften the dollar, ease the real burden of debt, shift national wealth into parallel systems. Force the world to renegotiate America's role. And whether you agree with it or not, one fact remains. When the dollar moves, the world moves with it. In the next episode, we dissect each of these shifts in forensic detail so you understand exactly how they shape your life.